Hi, welcome back. In this session, we're going to take a look at technical analysis, and we'll have a brief summary introduction to the topic. And in this first video, we're going to take a look at the first half of the material I want to cover today. Technical analysis is a topic that has become an important part of investments because it describes not just the fundamental value of investments, but it helps us to understand the trading behavior of markets. And it applies not just to equities, but also to bonds, to indices, to commodities, even to currencies. Because essentially at the root of all of technical analysis is understanding the behavior of individual traders. In this video, we're going to have a quick introduction to the why part. Why do we need to know about technical analysis? What is it all about? How does it relate to the fundamental analysis that we've covered in earlier parts of the course? We'll take a look at the particular types of charts that we use in technical analysis and the different contributions of each. And we'll look at how trends and momentum are relevant to what we're trying to understand. In the second video in this series, we're going to take a look at some of the technical indicators, including things like price and momentum. We'll take a look at market sentiment indicators and also the cycles of the market. But before we go on further with that, a quick introduction. Essentially, technical analysis, I think, has got a very strong image among investors, especially those who believe in market fundamentals. Market fundamentals essentially suggest that we can know everything we need to know about a company by looking at the quality of management, the company's products and its markets, and understanding and trying to develop a feeling for the inherent or intrinsic value of that particular stock. And if the stock is underpriced, we should buy, and if it's overpriced, we should sell or not buy. There's a general feeling that technical analysts are looking for particular readings, kind of like reading tea leaves in the bottom of a cup. If you look in the market and you see there's a particular type of a structure, then that's an indicator to buy or to sell. In this example from Dilbert, you can see the boss lecturing the young intern about stock investing, essentially saying that you should buy the stock whenever the chart looks like a squirrel sitting on a clown's shoulders. The intern says, yeah, that doesn't sound like it makes sense. And then the boss says, well, that's okay because it doesn't work if everybody does it, implying that it's always worked for him. Well, clearly there's going to be more to this than that particular type of formation, but in some ways he's just about right on. The logic of technical analysis suggests that there's more than just fundamental value in business, that the markets are not consistently rational, and that irrationality can generate profits. Well, that is a bigger topic. The efficient market hypothesis that we study from the very beginnings of our studies in finance tells us that value is inherent or intrinsic, and that we can recognize it or fail to recognize it. Technical analysis starts off by saying, well, if that's true, and doesn't say that it isn't true, if that's true, the price of assets tends to largely be determined not by inherent value, but by the supply and demand, especially for goods that are fixed in supply at a point in time. There's so many stocks that are available to buy, or so many bonds that are available to buy at a point in time, and money will enter or leave the market based on the enthusiasm of those crowds. People will say this is a good time to buy stocks because they're underpriced, and money enters the market with a fixed supply of investments to buy. The prices are bid up. And if the markets are looking like there are problems, people take their money out of the markets and go to cash or put their money into less risky investments. So we see that if supply and demand is true, and changes especially in demand happen in the short term, that can affect the price of stocks as well as their inherent or intrinsic value. The next further step is to say that we can observe the behavior of markets by looking at those charts and using other types of technical tools. There's some basic assumptions of technical analysis. As I said before, we start off with an assumption in all of economics that people are rational actors. They do what is right. We know that individuals don't always do what's right, but we assume that there is a wisdom of the crowds, that the markets are made up of not just individuals, but a lot of individuals, and that on average, the law of large numbers suggests that those people will make the right guess on average. Technical analysis says they believe that human behavior is often erratic, not necessarily irrational, but not always rational, and is driven by emotion as well as information. Market trends and behavior market trends and pattern reflect the irrational human behavior, and that those trends and patterns repeat themselves and as a result can be predicted. This was such an important idea and was well explained by a number of psychologists because it brought psychology into the area of economics with behavioral finance and behavioral economics. Best recognized through the work of people like Daniel Kahneman, Amos Tversky, who won the Nobel Prize in 2002 for their work in prospect theory. Also people like Thaler, who won it a couple of years ago, looking at consumer choice. And so the idea that markets are not necessarily rational, but behave perhaps with a type of bounded rationality or rationality with limits. For that reason, most investment sources recognize technical analysis and provide those kind of resources. From my own investment account, you see I've downloaded today's chart, or a chart from today, which shows we had a terrible day in the markets. We have a decrease of about 5.7%. This particular chart is for the Standard & Poor's 500 index with an ETF called SPY. And it shows, according to the chart, that I have a number of different information sources. Each of these green or red symbols recognizes information that is either bullish or bearish, indicates success in the future or failure in the future, and they appear to have kind of mixed reactions. We have bearish signals before a market improvement. We have bullish signals. Actually, Oliver, we don't have an actual bad bullish signal, but we certainly had one at this point. And in this case, that particular signal was a relative strength index, an RSI indicator. And if I click on that, I can get more information about that particular report. And here's an example for a company called Carmanah Technologies. It's an interesting company based in Victoria that produces things like solar lighting and other related technologies. And if I looked at a chart, and in this case it's an older example, and at this time my broker was using a technical analysis source called Recognia, and we have bear indicators marked by red R's and bullish indicators marked by green R's. And if I click on any one of those, it'll tell me that this is the type of indicator that's been provided. On this particular day, on the 26th of July, Recognia said there are a couple of indicators. Both of them are bearish. One is a symmetrical continuation triangle. Another is something called a top triangle. And so if I follow on to that, I can see what they mean by those particular type of indicators. When we say a symmetrical continuation triangle is a bearish indicator, I get this information. There's several things that I'd need to know about first before I look at the results. To start with, at the top of the chart I have a golden line. That's my resistance line. In other words, this is kind of a ceiling against which the share price has tended to bump before it recovers, before it falls down. So it's hard to break through that resistance line. There's also a light blue line at the bottom, and that's a support line. The support line essentially becomes the price floor. So we could see the stock price going up and down, tends not to break through the ceiling, it tends not to fall through the floor. We also have a couple of other indicators that recognize that there's an apparent trend on this particular time period's information. We have a couple of gray lines, and that indicates a downward trend. And more recently, you can see that the shape of the actual trading appears to follow a couple of short-term trends. In other words, we've got a lot of recovery here around the 27th of May, and in 27th of June, falling about the 11th of July, and then back up around the 18th, and so on. But the highs are lower, and the lows are also higher, and so that indicates there's some kind of a triangle going on there. Now, what does that mean? Essentially, it says that there is a downward trend, and we expect to see that downward trend continuing. So even though we've hit our support line, it looks like we're going to fall through the support line. It looks like the downward trend will continue. That's the indication. It's described as a symmetrical continuation triangle. In this case, we have a stylized version of the same thing. The share price behavior bounces up and down, but with lower highs and higher lows, and then eventually it's going to fall right through that, and the share price is going to continue downwards. So I would say that's a bearish indicator. Another indicator on a different day was a double moving average crossover. And here we're looking at a different kind of indicator. In this case, it uses moving averages, and we'll talk more about those later. We have the original 2 bits of information. We have our resistance line and our support line. So for the last little while, the prices tended to bounce in between those numbers. But something is happening between these moving averages. We have 2 moving averages. We have a moving average, the blue line, the light blue line, which represents the 21-day moving average. So it smooths out the movements on the actual daily trading to turn it into a 21-day moving average. We also have another moving average that's based on 50 days. So it's a broader version of the same moving average based on 50 days instead of 21. The long-term price behavior on this has been rising and is now falling. And the short-term moving average is definitely heading towards, well, it's being more strongly affected. And the point at where this crosses, from the short term to the long term, from high to low, look out below, is a great saying. So whenever we have the short-term moving average crossing the long-term moving average, we should look for a continued downward movement. Suggestion is that the market is incorporating new information. That's why the short-term average is moving more quickly downwards than the long-term moving average. So we should be aware, and perhaps that's a selling indicator. We'll talk a little bit more about some of those structures later. But before we do that, we should come back and review the ideas that charts provide information in slightly different ways. 4 different types of charts we're going to look at now include line charts, bar charts, candlestick charts, and point and figure charts. 3 of these 4 I'm sure you've seen before. The point and figure chart is a little bit less commonly used. For the first 3 of these 4 types of charts, we'll see that information tends to be presented either in a linear scale or a logarithmic scale. And you can see the chart on the left. On the axis on the left, we have the scale of 2,000, 4,000, 6,000. So it changes one at a time, essentially. The chart on the right shows an indicator in scale of 10. So 1, 10, 100, 1,000, 10,000, and so on. That's the exponential scale. Tends to smooth out some of the behavior and gives us an idea with more emphasis on the later information, allows us to spot the significance of some of those trends. You can see the use of an exponential scale or a linear scale for a line chart, a bar chart, or a candlestick chart. By a bar chart, you can see that here we've got an example which is giving us 4 pieces of information for every day, just for the price information. If you take a look at any of these points in time, you'll see that there is a line with 2 knobs on it. The line represents, the top of the line represents the high price for the day. The bottom price represents the low for the day. The bar on the left represents the opening price, and the bar on the right represents the closing price. So for certain days, you can see there's a lot of volatility, and that's highlighted because there's much more information about each day's trading than just a single data point showing us the open, the close, or the average trading price. So if I look, for example, at this day in I don't know, something like November of 2008, for this particular stock index in Brazil, my opening price was somewhere, or my opening value for the index was something like 40,000. My closing value was something like 30,000. The price rose at some point during the day to be slightly more than 40,000, but it pretty much finished the day at the bottom because there's no wick. There's no line below the closing price. The next day, we can see that there was again about another 9,000 points of recovery, and it closed up about 9,000 points from the open at the beginning of the day. So the benefit of this kind of chart is it gives us much more information than just a simple line chart. Another version that you may have seen is a candlestick chart. The candlestick chart is a very old type of charting tool, probably developed originally during the Meiji Restoration in Japan, and used for commodity trading things like rice. Again, we have a lot more information than we have with a simple point chart. We have the high price and the low price, an open price and a closed price. But here, if the closing price is above the opening price, we have a hollow square, and if the closing price is below the opening price, we have a solid square. So that's the key to understanding a basic candlestick chart. It's designed to show us that there is a lot of activity during the day, and the price can go very high and very low, and it shows us the difference between the open and close. It also gives us an idea what's going to happen the next day. It's predicting the future because we can see that the closing price is going to essentially be the opening price for the next day. And the next day in this chart, on something like the 10th, or sorry, next week, we see that the price falls by quite a bit. But during that trading period, it fell even more. There's a bit of a gap the next week, but at the open on the next week, we see another decline, so that by the time we get into the third week, whatever gains we had appear to have been lost. This helps us to identify certain particular patterns. And so somebody will say that if we see a very small amount of difference between an open and close, after a long period of growth, that could be an indicator that bad things are going to happen in the future. We've peaked, and now the trend is likely to head downwards. Here's an example for Carmana Technologies, and now you can see that not only have we got solid and hollow squares, and we've got the wicks on both the top and the bottom as before, but we also have got red and black. Here, if we've got a black-filled candlestick, like this one in February, or like these in February, they occur when the close is greater than the prior close, but lower than the open. A hollow black candlestick is one that occurs when the close is greater than the prior close and the open. The red filled candlesticks occur when the open and prior close are both lower than the close, and a red hollow candlestick occurs when the close is greater than the open but lower than the prior close. Now, I know there's a lot to remember there. Doesn't hurt to keep notes. Anyway, that is our indicator those are indicators that give us an idea of what's happening to the price, especially when there appear to be substantial things happening in these companies' markets, as appear to be happening with Carmana in these charts. A lot of reversals. Reversals are very important because they tell us when something is likely to happen. And For that, we have the point and figure chart. This is probably, well, is very different compared to the other charts that we've looked at, because the bottom axis doesn't represent a simple measure of time. These are trading experiences, and if we see a lot of improvements are marked with X's, and a lot of downward movements, those are marked with circles. These X's and O's, or point and figures, are another type of indicator that show us or give us information about reversals. In this particular case, we need 2 bits of information before we start. We need to know the box size. So each of these indicators is 1 Hong Kong dollar. And a reversal is seen to occur after 3 movements. So after $3 movement upwards, we can a full reversal is indicated by 3 downward movements. And so in this case, we had an uptick, followed by an uptick, followed by an uptick, followed then by 3 downward movements. You see there are no patterns of 2s here. They're all a minimum of 3. So this was followed by a reversal of $3, 3 Hong Kong dollars in trading movement downward. And then we see several upticks of $1, followed by a bunch of downticks. This becomes helpful when we see a long run of negative movements. So a long run of negative movements might indicate that we're, in this case, long run of downward movements, short of upward. Long down, long down, long down, huge long down. And this is really what we're worried about. So clearly the market is reappraising this business, because now we're seeing that the overall trend appears to be downwards. A lot more O's than there are X's. And so that is the purpose of a point and figure chart. It helps us to identify patterns. And that's what we see for Carmana in this example. So the stock prices are marked on, well, the right and the left-hand side. And apparently there's some kind of a pattern that is observed by the analyst who's looking at this, described as a quadruple top breakout. And so we've got X's with a few O's, but mostly X's. And so we have an upward trend, an apparent upward trend, followed by a downward trend, downward trend, bit of a recovery here, followed by more downward trends. And so again, the purpose of the point and figure chart is to be able to identify that kind of trend. Not as commonly used as the candlestick or the bar chart, but it's another tool that people need to be aware of. Price information has mostly been the focus of what we've looked at, but people who are serious about technical analysis spend as much time talking about volume as they do about price. Volume information is particularly important because it helps us to spot changes in a direction. For example, if we're looking at whether or not a price is trending, either higher or lower, if price is trending upwards or downwards and its volume is increasing, there's an indication that the trend is going to continue. If the volume is decreasing, whether it's going up or down, it looks like that particular trend is going to end. We're moving towards some kind of a divergence or a change in direction. So that is also something that, again, we're just introducing that topic today, but it's also something that's very important. And it is something that we'll talk about with structures when we look at those later on. We also want to know how well we're doing relative to an index. And here we've got a couple of stocks relative to a standard index. In this case, the Standard & Poor's 500 index. So it looks like our first example, HOG or Harley-Davidson, is outperforming the index because we have a long run of improvement followed by an underperformance. This other company, RODM, pretty much consistent with the market, but they appear to be outperforming the market during that period from May to July of 2009. So the relative strength, the strength relative to the market is important. How well are we doing compared to everybody else in our gang? And our gang would be the Nikkei index, the Standard & Poor's 500, the TSX index, and so on. We're also interested in trends. And as they say, the trend is my friend, from that terrible cliche. But usually companies that are heading in a certain direction will tend to stay headed in that direction until we have new information or until the market provides us with a major correction. In this case, our company is China Mobile, and from this period in 2004 to pretty much 2010, the company's performance really doesn't vary. It's always going to be heading upwards. One of the things that tells us that this is going to be a persistent uptrend is that the highs tend to be higher and the lows tend to be higher. So it's not just that we have a general overall trend, but there are higher highs successively over time. That's an indicator that demand is exceeding supply. People start to sell, the price comes down a little bit. There are going to be lots of more buyers who are willing to jump in and buy the stock at a reasonably high price. In the case of a downtrend, and we do see a little bit of a downtrend in 2008, but that's quite understandable. The highs, successive highs, tend to be lower, and the lows tend to be lower. And in this case, that means that there are more people that are willing to sell than are willing to buy, and so that is a bad sign. We'll talk a little bit more about momentum and trends in the next part. But essentially, people like Burton Malkiel, who we remember is an economist, a finance professor, Princeton University, a best-selling author, who's talked about markets essentially being random and is definitely not a technical analyst. He would say that trends tend to perpetuate themselves for one of two reasons. One would be the crowd. The herd instinct that we've discussed from psychology essentially says people are jumping on the bandwagon, and that trend tends to be a self-fulfilling, but probably wrong, prophecy. The other reason why we could follow a trend for a long time, while the trend might persist, bad information. So we have perhaps unequal access to information about a company from all of the different investors, and that would lead to a gradual increase in price. Now, trends tend to be described using some standard terminology, and we have already looked at that. That includes things like resistance and support lines. In this particular case, you can see that our stock is bouncing between the resistance line, which is initially a resistance line, and the support line. In other words, our price goes up to $45 and the market's decided $45 is the maximum that anybody should ever pay for this. And then people say, yeah, 45, good point to sell. I'm going to get out of the market. And other people buy back in. The price gets bid back up almost to 45. Doesn't cross that magic line because people say that's the most that stock can possibly be worth. Perhaps it's expressed as a price earnings multiple. I would not pay more than 18 times that company's earnings. But that becomes the limit to the price. The bottom price, the support line, is the line where people say anything below $6 is going to be a bargain. And so they'll buy anytime that stock hits that price. That becomes the de facto support line. In this case, we have a breakout. And at this point, we broke through the resistance line. And once the company stays above the resistance line, we'd say there's a change in polarity. Essentially, now we say that's our new support line. Anything, and sometimes it isn't exactly the same point. Maybe $40 was our resistance and 42 becomes our support after a strong run. And so we look for structures like this. When have we made a significant change in the market's estimation of the value? That's what happens when we see that breakout and the change in polarity. There are two things that we look for in patterns. One of them is the reversal of a direction, and the other is the continuation of a direction. If the company is trending upwards, a reversal means it's likely to fall. If the company is trending upwards and it's going to continue trending upwards, we look for a continuation pattern. I'm not sure that any of these patterns is truly valid. They don't do well in empirical testing. And by this I mean the out-of-sample performance. Often when we look at the patterns, we can say, yeah, look, that is definitely was a head and shoulders pattern or double bump and run. How could I possibly have missed that? But then when we see it starting to happen again, well, chances are pretty good that afterwards it'll look like something else. So kind of like the squirrel sitting on a clown's shoulder example at the beginning. This is like reading tea leaves. This is like trying to interpret things that maybe shouldn't be interpreted. However, there's some standards that we look for. Reversal patterns include things like a head and shoulders pattern, double tops and bottoms, triple tops and bottoms. A sign that the market is likely to continue include things like the triangle that we looked at earlier, a continuation triangle, downward continuation, rectangles, and flags. And so we'll have a very quick look at those, and that's what we'll finish this session with. Here we can see why we call it a head and shoulders. We have a shoulder, followed by a head, followed by another shoulder. And we've broken through a resistance line to get to the first shoulder, and we fall through the support line, and essentially that suggests there's a change in direction. So our market was heading upwards, and so we now see that we have a new trend. In order to fairly interpret and fully interpret a structure like this, we would have to have information about volume. And volume, something happens here. In November of 2005, there's a big spike in volume, but as we ride through the market, the market is starting to form a substantial opinion, and it's not a good one because you see there's a lot of selling activity on the right-hand side or the right shoulder. So lower volume for the head than there is for a shoulder tends to indicate a reversal. So that would be something that we'd look for. Similarly, and again, I don't understand all of the things that go into all of these structures, but somebody who's particularly looking for a double tops and bottom would say that, look, here we have got two touches on our support line, and so that indicates a double bottom, and that's going to suggest that there is a change in direction. So we had a decline in this stock, followed by a bit of a run, sometimes called a double bump and run. So in this particular case, we've got a lot of volume, a lot of buying activity as we approach the support levels in both these cases. And now the company stock appears to have picked up some wind. Here we've got the same kind of thing where we're hitting, in this case, not the support level, but the resistance level. We're hitting the top, and appears to be very little volume support to try to help the company to break through that resistance level. We'd already introduced the idea of triangles, and you can kind of see, especially in these stylized versions, what we mean by a continuation approach. The company hits hits a resistance line, bounces up and down in between what is a static support line and appears to be a trending upwards resistance support. And so it's gathering up steam to eventually break through. And again, I would look for rising volume and not just take a look at the direction of the line. And here again we see a continuation, but this is a downward or a descending triangle. Rectangles. Again, here we have our resistance line and our support line are both parallel in this case, but essentially doing the same thing and giving us the same information. So the difference between a triangle and a rectangle, a flag and a pennant, essentially seem to be very limited. And flags and pennants, here essentially the only difference between a flag and pennant is basically we use the same term. It is that we have converging support and resistance lines. As I said at the beginning, this is just an introduction. If you want to know more about this, there is an awful lot that we can read. We have the text that I mentioned before, the CFA textbook that provides this introduction by Peary, Macmillan, Peary, Pinto, and Deventer, and highly recommended. Also, I will be covering in the next video a bit more about technical indicators, including price and momentum indicators, market sentiment indicators, and cycles. Please join me for the next video.